Hi guys, this is Terry with Futures.io. It is my honor to welcome back Linda Raschke for today's webinar, Habits of a Systems Thinker. During the webinar, if you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. Also, there will be a book giveaway at the end, so pay attention for your chance to win one of the 5 copies. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. You can now follow us on Twitter and Facebook at Futures.io. We're working on some new content for these sites and appreciate your support. And without further delay, I'll hand it over to Linda. Okay, you should get a pop-up box.
You got it?
Yep, looks good.
All right, are we ready to go?
Yes, we are.
Hi, gang. I'll tell you, there's got to be something. I'm the best indicator there is. Anytime which is not very often, I volunteer to do a webinar here, I swear the markets are totally crazy. So if I appear a little bit initially scatterbrained, please forgive me. The topic that I wanted to talk about today was inspired from a book that I read, and that book is called Thinking in Systems. It was written by a gal, Donella Meadows, actually in 1993, so the subject matter is not necessarily new. And I started to put together this webinar and was grappling a little bit with these semantics, because systems thinking does not imply the traditional systems that we think of when we are trading the markets or developing quantitative strategies, etc. So systems thinking actually is all about how elements interact, including the people, the structures, and the processes that operate together. So we're really dealing with the grand theory of the universe here, you see. And my hopes in presenting this seminar or webinar to you are that A, it'll open your mind into perhaps looking at some structures in a different light. B, you'll start to see the challenges we have in our linear thinking where we do try to model particular variables or sequences in the market. C, I always feel that people are assuming that there's some way that they can have some type of prediction or control over the markets, and we'll see just why that is so impossible. And then lastly, hopefully we can take it down to something practical with a few tips for money management strategies, because I hear a lot of times people very frustrated that they're out too early, they're out too late, do they trail a stop, so forth and so forth, and this will put to rest at least what the optimal approach is when you grasp this question. And actually our subject today, it is perfect because just to give a quick illustrative example, one of the things that we're going to launch into right away is the topic of dynamic systems, where it's not a closed universe. Obviously, everybody knows this. The variables are always changing, and things can come into play at any time. So the market's going to alternate between these states of the oscillating behavior, the negative feedback loops, where all of you that are so familiar with the market profile concepts, you see the market striving to reach a new equilibrium point in testing back and forth. And then once we get those positive feedback loops, we can get accelerating behavior, meaning exponential. Things will go much further than we think they will. That's Soros's theory of reflexivity, that we will always overshoot what would be an appropriate value for the market. Or we can get very erratic, random, chaotic behavior, perhaps the type of movement that we saw a few nights ago in the British pound. There's lots of possibilities, and none of them are anything that we can control or predict, but we still know how to view them in our trading, how to capitalize or take advantage of them, and again, just hopefully increase our awareness overall. This is that same as, I'll show you two kinds of charts today. It's always fun seeing data displayed in different ways. And this is a candle volume chart, which you will be able to see the volume by the width of the bar. I believe a Market Delta has this type of display of data. This is the Photon charting platform that's actually part of their execution platform. I believe that you can create something similar with TradeStation now, but just be aware that when you look at this chart, you will see, for example, right up here, this big fat bar is indicative of very high volume, and you will have to remind yourself that we'll always see heavy volume on a market's opening and heavy volume on the market's close. So this big volume bar actually was yesterday on the close, going into the close, and it was very heavy volume. So don't necessarily read more into it, although it is significant, and we will look at the ways later. So just to sum here, and again, I'm not telling you guys anything that you don't already know, that you've got this negative feedback oscillating type of mode, and then this positive feedback type of mode. What's really interesting is that there have been a lot of long-term studies that can classify people's behavior in these types of markets that we will look at a little bit further on. And, you know, I know some of us are strictly technical looking at the price action, but if we also know why things are happening the way they are, or why certain people or groups of people are behaving the way they are, it might just give us a little bit more confidence when we're initiating trades in certain conditions. So this right here, interestingly enough, is the same data, but just going much further back. So the data that I just showed you prior started right in here, and it was this little oscillating mode here. This is very squished together, and then that was that big ABC, that positive feedback loop going up. So with a swing chart, what we can do is we can compress the data so we get a much different picture, and it shows us a different type of structure. And obviously in this chart, what you see is a bunch of noise, a little bit of randomness. And if I were to give this data to somebody and say, create a mechanical system, you can see how challenging it would be. Really what you can do is look for the way that the price acts around certain levels, and you can see that we did fluctuate around this central value of 21.52, which we went through the downside today like a hot knife through butter. But the main thing is that with this short-term data, it is very noisy. So let's back up here and again just define systems thinking, because I was talking to my brother who last night, he's always one that I bounce ideas off, having his being unemployed for the last 7 years, but with one of those minds that has all these advanced degrees in abstract mathematics, which is probably why he hasn't been able to get a job for the last 7 years. It's not the most practical thing right now when you live in San Diego. So I said, Stephen, you know, I'm really having a little bit of awkwardness here, because systems thinking refers to systems in the broad universe, the way, you know, we operate, life cycles, all different types of organizational structures and so forth, whereas when we're in the market, we like to think of systems as being a mechanical strategy. Also, a little bit confusing, we start to think about the term systematic, which is about going about things with a distinct process and all these types of so forth. And he said, well, you know, just make sure that if you're going to refer to systems as a trading system, which we will look at the end of this, that it is a mechanical system. And so I just want to remind you that this systems thinking is not thinking in terms of how to develop a mechanical system for the strategy. Instead, what I want you to think about is the way that we can alternate between these states of these positive feedback loops, such as we saw in today's trading, versus when we start to consolidate and try to find an equilibrium level again. And if you can increase your awareness of this back and forth, and we can start to look at some of the signs that alert us to an aberration or the fact that a system is approaching that point of instability where it all of a sudden is going to explode in a positive feedback loop or straight line type of thinking, you will be better prepared to take advantage of that, because one of the things that I see in the marketplace is that traders have a very difficult time switching gears. About 80–85% of the time, majority of short-term traders are in this reversion to the mean type of mentality, looking for the short-term turning points and the reactions back. And sometimes it leads to perhaps getting frustrated because the market gapped down this morning and not recognizing that we were hitting one of these loops right away. The frustrated trader might look to make a long trade for their first trade of the day without looking at the signs that, oh, okay, I've got a checklist here. A, B, C say that we've got 80% odds that we'll be in this dynamic, expanding type of environment, you see? So our minds like to have this straight line type of thinking, and all of these slides will be here that you can read later, but the main thing is that it's a constant reminder that this is a very non-linear universe that we're dealing with. I mean, at least when you're playing poker or blackjack, we know that we have incomplete information, right? We know that we have to make our best guess with not all the variables there on the table. But at least you also know how many cards are in the deck, and all the cards are going to be black or red. And so it's a step beyond that with the market. Not only are we dealing with this uncertainty and this impartial knowledge, but we're also having to deal with the fact that there really are no boundaries. It isn't a finite set of cards with, set suits. So let's continue here. Every system has a goal, all right? And when we're in this negative oscillating type of mode, which leads to, I think, an environment which most traders actually enjoy trading, as long as there's enough range in the swings back and forth. The goal is to be trying to find this equilibrium level where the buying and the selling pressure come into accordance with each other. And of course, those are variables that are always changing at the time too, so it's not a fixed value. But again, I feel so confident that you guys are one step ahead of me in knowing what I'm talking about, because many of my audience are so proficient with auction theory and this market profile type of displaying data and all the concepts that come along with auction theory. And even if you don't use market profile or auction theory, if you will, in your own trading, it's still a great thing to read about just because of the way that it presents concepts to us. So back to one of the things here that we have to grapple with, and that's that we never know reality fully. We like to think we do, but we always have a model in our own head, and everybody has different models in their own heads. And of course, our models are fairly close to reality, all right, hopefully, unless you're on major drugs. But we never can see everything that's out there, and that's why I think that So many people are surprised at certain points in the markets. They're surprised when the market acts a certain way that they weren't expecting, all right? And that's, again, another lesson as to why money management is ultimately going to be the key, whether you make it or break it in this game. Okay, so we know that the world's full of nonlinearities, and so our little poor peon linear thinking minds would like to think otherwise, but it doesn't work that way. Understanding this, okay, we want to look at now what is going to flip our systems or our structures from one mode of behavior to another. So let's just back up and look at the two main theories for price discovery and pricing in general. Equilibrium theory. Prices in the long run reflect the underlying fundamentals, okay, assuming that everybody knows what they are. But the supply-demand variables working towards determining equilibrium, well, I can tell you right off the bat, if you want a practical tip, I love nothing more than looking for the 3-bar balance areas, or it could look at a sideways line on a 120 or 240 minute chart. And unfortunately, I didn't want to put so many slides in the presentation today, so take out a pen and pencil and paper and write down to look at where you get these 3 bars overlap on daily candles with a 120-minute type of converging trend lines or sideways line. And those are very often the points where we get our pull away from that equilibrium level that things can start to accelerate. Whether or not we go into a positive feedback type of loop or movement is dependent on a few more factors that we will look at. But that's the equilibrium theory, that we're always shifting up or down, trying to find value where the buyers and the sellers agree. Now, reflexivity is something that Soros popularized. It was actually put out there much earlier, but that is that these markets tend to overshoot once they are unfolding here, and the prices influence the fundamentals. So you get these reinforcing positive feedback loops. For example, stops are hit, and then the trend followers step in, and then that drives prices down further, and then that might cause more liquidation, and so forth. So that's a very short-term technical pattern. But we can also see it all the time in other areas. Soros gave a great example of when prices are rising, as they were in the housing market in 2006, 2007, the banks eased their lending standards, right? So they made money even more freely available because values were rising, and it was easier to justify making the loans. So of course that then fueled more buying power and so forth, and can lead to a little bit of a parabolic type of move. And then of course when the prices start falling, all right, that's when the banks pull in their horns and they're not lending, and they make it harder to get money, and that pulls away one more factor of demand, and it can lead to prices falling well below where they should. So that would be a real world application of where the behaviors of the institutions out there in our economic environment actually tend to aggravate these boom-bust cycles. And of course everybody's looking a little bit right now with the excess Fed, policy and so forth. What will the effects be of that in the long run? Well, we don't know. We can just observe that this type of behavior can lead to these types of situations. So real world applications abound left and right. And we're so used to thinking A plus B equals C. 1 plus 2 equals 3, that we don't get it when we do 2 plus 3, but it still only equals 4. We don't get it. Or 2 plus 3 could actually equal 13 once you hit one of these random loops. So all of this, we're going to try and bring this down to some practical applications in the charts. So thank you for being patient with me if I just go over a little bit of a foundation here, because it's a stretch. It's really hard to think in terms of abstract terms when you're coming off of a trading day like we just had. So just again to summarize, very, very difficult to come up with quantitative solutions for the markets because they will work in a certain type of environment where we have well-behaved price action, and then the thing can completely fall apart. And a lot of the systems that perhaps were viable, strategic systems or strategies 20 years ago or even 10 years ago, may not be so durable and robust anymore. So that's why part of system thinking is being on our guard to see if there's changes in the variables or the way things behave. So, you know, it's a, I don't want you to lose sleep over this, but, you know, it just tells how much uncertainty there is in the markets. And I'll tell you that that's a difficult thing to deal with for many people, for many traders. They are on a never-ending quest to come up with one more indicator, one more filter, one more you know, variable to solve the equation. And then a lot of engineers, it can just drive them crazy. They think that there's a way to put all this in some type of black box. And there's not, because even with the machine learning that we see going on nowadays, the algorithms, the machine learning algorithms, they're still competing against each other, and then they're going to create their own little random positive feedback loops wrestling against each other. So it's not necessarily like anybody is ever going to find the answer to this. So if anything, it always is going to teach you to be prepared for surprises. Now down to the practicals, there's been a lot of studies that look at the way that professional traders behave when the market is in a nice trading range. And obviously the most general example would be buying when price is low, a stochastic is low, or at the lower end of the trading range, or below your value area, and then selling when it gets back to value, or selling when it gets above it. And this is a nice way to trade when you have a well-defined boundary. And professional traders will tend to practice this type of approach. It's your traditional buy low and sell high. And eventually you'll try to wind back down to this equilibrium level. And if only it were so easy. But they did another study that showed that that same group of professional traders out there, and I'm speaking in very broad terms, if you now added a trend, okay, a trend to the data, and it's a channeling market, that professionals now will change their behavior and they will actually start to chase prices, okay? They will actually buy high because they're betting that the future people coming into the market will be willing to pay even higher prices. So they've actually stopped this behavior of fluctuating around this central value, and professionals will sit there and completely change their behavior and become momentum driven. And it doesn't matter that the prices are way too high. You're still betting on the fact that they are going to rise even higher. And that's exactly what happened in that real estate bubble in the mid-2000s. You know, even professionals, they knew that prices were too high, but that still didn't keep them from speculating on new condos and so forth. And they kept on over-leveraging in anticipation of being able to flip it for an even higher price. So that's one of the documented things. Okay, so there's been quite an abundance of examples lately. And what we're going to do is we're going to look at three things. We're going to look at what these types of behaviors or these feedback loops look like graphically. We're going to look at, are there any data points where we can say there's greater likelihood of having a positive feedback loop that we can perhaps take advantage of, or at the very least not be caught flat-footed on, you know, and you know, just in general, some of the challenges in dealing with these swing structures. Now, this is so beautiful because we had some crazy moves over the last week and a half here. And this is actually a chart of gold. It's a candle volume chart, but it really shouldn't matter when the data is squished this close together. Now, I find that the nice thing about the candle volume is that when there's not much volume, it really condenses the bar chart, so you can see these swing highs and lows much more clearly. Or likewise, even with those swing charts, now a lot of software programs have a function called zigzag or percent swing, and there's no right or wrong variables on these. You can play with them and just pretend that you squish up the data and take your glasses off, and you'll get the idea real quickly here. So gold and silver for that matter, for them to drop that much that they did, you have these positive feedback loops. And what happens is once you hit these data points, if you are on the wrong side of it, invariably, newer traders will sit there, if they didn't have a stop in place, well, they might not be a trader for very long, but they will sit there and they'll freeze and they'll start waiting for that first reaction back in the opposite direction. And you know darn well by now that the markets, once they hit these points, are very efficient. That's one of the things that has changed in the last 20 years. I don't know if it's because you've got broader bandwidth everywhere, or perhaps a little bit more algorithmic, mechanical type of trading strategies. But the markets, when they are noisy, are exceedingly noisy, more so than ever before. And if you look at this chart here, you can see this is what I mean by noise. A lot of chop back and forth, and we actually had some textbook converging trend lines there. And I know there's a lot of algorithmic strategies out there that look for a lower volatility reading. They often go down to the tick data, and then once the strategy is triggered, they're in and they'll tend to trail a stop or whatever. There's lots of false breakouts as well, but that's something that goes on out there. So anyway, you can see this extreme state change, and again, it makes it much more difficult if you are trying to come up with a mechanical type of strategy or a way for modeling the data. Everything looks great in hindsight, right? You know, in hindsight you can see, oh yeah, well the weeklies did an ABC up, or things like that. That's one thing. Everything looks perfect in hindsight, but were you there to capture it? Were you prepared when things were unfolding? Here's another chart of the bonds, and one of the things that will lead to a positive feedback mode is this breach of support or resistance, because stops can start to increase the buying or selling pressure, and then you get the trend followers jumping in. But I just wanted to point out that there are no hard and fast rules either. So for example, on the bonds, you can see we did trade below that previous swing low, but it didn't really lead to much until we actually took it out down here. And on this consolidation of the bonds at the bottom of this swing, it was actually an expanding pattern. So we still drew our line, we still developed a central value, okay, to bring that market into equilibrium. However, I wanted to point out that it doesn't have to be converging trend lines that lead to a textbook breakout. You see, that's the challenge that we have in dealing with the noise out there. I hope everybody's going to be able to have a good stiff drink tonight after this lecture here, because I don't mean to make it sound so complicated. We'll try to find some little mechanical things to latch onto at the end of this. Okay, and same thing here. It looks pretty textbook that the bonds rallied right back to the middle of that trading range. Coming down here, because we did take out that swing low there, and it did lead to a little bit of chop and consolidation there. So sometimes it's obvious, sometimes it's a straight line linear move like we had down on that side of the chart, and other times it's not. But again, our first goal in looking at this was not to be surprised at anything that happens. Our second goal is to curb the reins on our little wheels in our head that like to project, okay? I don't know how many of you find yourselves getting caught up in that trap, but you're like, okay, we did an ABC down, now we should do an ABC up, or we'll retest up halfway, or we like to project what we think could happen. And again, it might look perfect in hindsight. For example, when we were rallying up to this point here, 168.24, you'll be like, oh yeah, well that was that area right over there. But when you're in the heat of the battle and you're trading, you know, we're really at the mercy of our own humanness, if you will. So it's never as easy as it looks. And that's the challenge with technical analysis, is that there is so much gray area too, okay, and nobody knows. I mean, I'm not going to go into some of the sham that you see with indicators and goofy stuff on the internet, but I'm assuming you guys are a very sophisticated audience and know better. So I also wanted to show you a chart of ultimate noise, okay? So this would be a chart of the 5-minute S&Ps, and you can just see the ultimate noise that happened here. It's a very challenging environment. Now, one of the keys for trading is being selective in your spots. And as we get more mature and more experienced, we also learn to be more discriminating at where we enter the markets and what our expectations are. All right, so the thing that I wanted to point out with this particular example on the 5-minute chart is that I was talking about how once you take out support or resistance, that often can lead to an acceleration in one direction or the other. But I wanted to show you here the total lack of volume on the penetration of that low. Now, this is just a little phenomena that I will bring to your attention, and you can study it for yourself in case you haven't noticed it already. And that is that usually when the market hits these intraday swing highs and swing lows, there is some degree of algorithmic activity there. So for example, if you saw a big 30-minute volume bar, you will notice if you drill down and you look at 5-minute charts, 1-minute charts, 30-second charts, that a very high percentage of that volume is coming in at a very specific data point, more often than not a little swing high or a little swing low. And I'm not sure if it's just stop activity. I tend to think not. I think it's initiating activity, and I think they're very quick to get out. That's my own 2 cents worth, although we'll never know for sure. But I think it's algorithmic initiating activity, and if it doesn't get anything, then it's pretty quick to exit. But notice here on this breakdown that we did not get any increase in volume whatsoever, regardless of the fact that the time of day was going into the lunchtime hour. It's still, I mean, today we had plenty of volume in the middle of the day, but there was no volume on this breakdown. So one of the things we will be aware of is confirming things, gaps, volume, range expansion, and more importantly than that, in our little myopic world, stepping out a time frame, okay? We have to keep on stepping out and asking the structural context that we are in. So I just stepped out a range to the 15-minute charts, and you can see this data right here. This was the little bump down that I just showed you in that previous slide, where it looked like it was a possible break of a good support level out of this little consolidation. But truly, we were just still in a trading range type of environment with a broader parameter at the upper and lower bands, all right? And if we step out again, now we're on a 120-minute candle volume chart. This is 6 weeks worth of data. All right, and I know everybody has studied this chart formation intimately well, judging by the action that we saw today. Interestingly, here was your classic positive feedback loop, this big flush down. Now, this was not Brexit. That was another period in the data. So I'll mention right now that these little positive feedback pockets, if I'm not being too redundant in referring to them that way, maybe happen 15% of the time. They're very quick. You're not going to get a retracement. And the best money management is just to keep trailing a stop, trail a stop, keep it relatively tight, and take whatever the market gives you. That's how you want to deal with a breakout. Some breakouts only carry a little bit. Some carry a lot. All I can say is trail the stop because it's a numbers game. Take what the market gives you. Once that market starts to react back in the other direction, don't necessarily get caught up in looking for the flag formations too quickly, because the market will tell you if it's not going to bounce much. It will sit there and trade around for a day or even a day and a half before it starts to form a continuation pattern. So don't be too eager once we have one of these positive feedback loops. I mean, for example, look at today. We traded down to 22 and we rallied back to what, 35? Okay, that's a pretty significant bounce. That's a 13-handle bounce in the last hour. And the reason I want to emphasize that is because this theory of reflexivity, it'll show more and more that these urgent markets tend to overshoot, and then we see stronger reactions back. We may not. Obviously, the bonds right now are in kind of a grinder mode to the downside, but just be prepared that they can snap back further than you think, and nobody can predict that. So anytime that we have this sequence, big down followed by big up, and this has been something I've seen for decades, the most probable outcome is that you will start to form swings in both directions until you wind back down to an equilibrium level. I've seen that for 25, 30 years. Big down, big up doesn't happen that often, but the most probable outcome then is that you spend a prolonged period forming some type of trading range, ideally a triangle. So now, interestingly too, when we broke from that top that led to that big down, of course, it's easy in hindsight to see the little 3 pushes up or the wedge, right? I mean, everything looks so pretty in hindsight. But what really led to this power of this downside break was the fact that you can see too here that you actually had formed a line or a value area or some type of quasi-equilibrium point. And that really is one of the most powerful drivers, is that when you can start to accelerate away from these sideways lines. So again, it's kind of like basic technical analysis breakout theory there. Now I wanted to step out once more because the data that we were just looking, I promise I'm not going to drive you guys crazy, the data that we were just looking at was this data right here, where we had that little bit of a wedge and then that severe flush down and came back up. But now how does it look? How does it change if I increase even more data? You see? All right? And this is why I really feel strongly that despite all the algorithmic trading and the machine learning and the artificial intelligence and everything out there that they use to teach these machines and stuff like that, I do believe that they're not really going to know any better than we. They'll just probably have better money management in the big scheme of things. As much as you fed this data into any type of learning program, there's enough randomness out there, there's enough chaotic behavior that doesn't repeat itself the same way, that I think it's going to forever be a challenge for certain types of strategies. Now I had to step out one more time, and you can see now the lovely thing in squishing together these swing charts. This is 240-minute data, by the way. It is not a daily chart. And you can see at the bottom this massive spike from the Brexit thing. Okay, now we did a lot of modeling with structure based on swings, and it's much easier to do this type of modeling when you get higher time frames such as a 120-minute chart, a 240-minute chart, daily chart. It's very hard to apply some of the tendencies when you get down to 5-minute data and so forth. There's just too much noise. But one pattern that models out very well is if you have a swing that's greater than the previous upswing and the previous downswing, all right? In other words, making a V. You want to enter on the next reaction. Okay, so that's a really high probability trade. Anytime, let me just repeat that, this downswing here was greater than the previous upswing and greater than the previous downswing. We rallied back, and this upswing here, now I know it's a little bit twerpy because you've got this data point up here, and I'm not quite sure why the algorithm is not picking that up because this is actually with CQG, and it's got some ATR function off of there, so this may be a little bit odd here, but I'll just show you one or two more data points, and then you can look for this for yourself. Never take anything that anybody says for granted because you have to see this stuff for yourself. So for example, here was a case where this upswing was greater than the previous downswing and the previous upswing, right? And yet then the next downswing was greater than that. So this area right here is a very high probability point. Now it just led to a push below, okay? It didn't lead to any big win. We're not looking for the positive feedback loops necessarily. It's just a small trading strategy that you can look at as well. So I'm not going to belabor this, but let's just get on to some more structure because I want to start bringing up some of the factors for you to look at that do lead to these, quote, positive feedback loops or these extreme movements. So I'll just read off 4 of them to you right now. And that is, obviously, stops being hit where it's significant support or resistance level. That always brings in new buying as well as shorts covering or vice versa. So a breach of a major support or resistance level can easily trigger off one of these loops. A market imbalance, for example, overweighted by too many speculative longs or overweighted by too many speculative shorts can cause what I call a long liquidation flush, or most of you are familiar with a short covering rally or squeeze. So this chart here on crude at this data point right here, this is 240 minutes, so this actually covers, you can see, almost 6 months worth of data. That flush right there was where the market was overly weighted with longs, and it just had to have that very sharp liquidation flush and come back up. Now another factor that can trigger these types of things is sentiment ratings, because again it shows there's a market imbalance. Either everybody's too bullish or too bearish. That means that there's too much cash on the sideline waiting to come into the market in the case of the stock market, or in the case of tops, you'll see the sentiments are very bullish because everybody's already long. So that's another thing that can lead to these things. Obviously the sentiment in the gold recently showed a prolonged imbalance with commercial shorts and you know, speculative longs and hedge fund longs and so forth. So that was just a liquidation accident waiting to happen. And then lastly, points where you'll get trend followers coming into the market. That also is similar to a significant support or resistance level being breached. Now, here is what I want to point out to you. When we start going back to our systems thinking, which is what we really wanted to increase our awareness of, most people tend to see the market in terms of events. And if you listen to the nightly business news, you will hear them describe that market's action in terms of events. Oh, the Fed was rumored to raise the rate, say they're going to raise the rates. Oh, OPEC decided to do X, Y, Z. Oh, North Korea is waving their sabers, or whatever the event might be. Usually the price action is described in terms of events, and that's especially, as traders, here we are subject to all the economic data that comes out every morning. And if you let yourself be driven by events, you will find yourself being extremely reactive, okay? We don't want to be reactive to events in the market. They tend to be short-term noise, if anything. So instead of an event, oh gosh, OPEC said this or OPEC said that, that's meaningless. A systems thinker would be thinking, let me look at the whole. Is there a structural point that could be risk? Is there a market imbalance? Is there sentiment readings? Is this ripe for a squeeze or a flush, according to the data? They'd be looking at some of these types of variables with an open mind. And of course, the challenge is that it's difficult to quantify. It's difficult to create a mechanical system using this type of data. But it's very important to step back and question ourselves. Sometimes when we feel too pat or smug that a certain scenario is a given, that's precisely when we can be proven wrong. And so always ask yourself in your own thinking, what would invalidate my thinking on this? Yes, maybe something has a seasonal long period, but sometimes the failed seasonals are the ones that can lead to the greatest moves in the opposite direction. So you always have to question yourself. I know that most of you by now, too, are familiar with the trap of these cognitive biases. I know that a lot more has been written about this. If you are not familiar, simply Google cognitive biases, and you'll find out all the little mental traps that you can fall into as a trader, especially if you're newer. It's I think one of the best things that's been brought to trading is this more staying in the moment, this bar by bar, following the price action or one swing at a time type of thing. Okay, because it keeps you always looking at what the market is telling us. But at the same time, you still have this balancing act of having to step out, see the big structure, where are the danger points, and so forth. So I don't want to belabor that anymore, but let's move on just a little bit. The booms, hourly chart, sometimes the data is well behaved. Now again, you've got 4 months worth of data here. And I have these emails that I get once a month, and it gives me the top 40 trend followers. And some of these people, Dunn and Winston and Campbell and all these guys, they've been around for like 25 years, so they're no dummies. And most of them have like the most ridiculous supercomputers and processing and teams of applied mathematics PhDs, and you get the story, right? They've got the technology infrastructure to process and massage a lot of data, but yet their performance really has been dismal over the last couple years on whole, and they're so dependent on capturing that one extreme outlier, for their performance. And this is a classic case as to why it is so difficult to model this stuff. These are the bonds, and you can see we have this beautiful negative oscillating mode, right? And then here we had all the reasons why we could have had a potential positive feedback loop when you broke out of this to the upside. You can see we had the converging trend lines, a tightening of the swings, everything under the sun, and instead, whoops, it turned out to be a bit of a bull trap, okay? So that was a bull trap. We came back down into the range. Now you guys know from today the number one rule is when you have a bull trap, a false breakout above down through the middle of the range, which was this 52 level in the S&Ps, And if you don't find support, you're going to go then test the lower end of the range. So what happened here? We did exactly that, and we broke out the downside. But did this lead to a prolonged positive feedback loop to the downside? No, it didn't. And this is why I say, when you are here, you just trail a stop. You take what the market gives you. 1 out of 10 is going to be a giant, giant home run. The rest will snap back and take you out, and that's okay. But look at this. Back again, who would have thought? Now we broke out here to the upside and failed, but yet this time when we broke out to the upside, we made a higher high. All right, so that's how schizoid this data is. And the people that I see, or rather the outfits that I see that are able to systematically extract profits from the market, and there are some, they're doing it on a very short-term basis. They're using tick charts. They might be in a trade for no more than 10 minutes. They're doing this 1,000 times during the day per market, and so forth. It's not a game that we can get involved in. And so I do think it's important for us to model the market, which means asking questions. But I just hope I can chop off some of the expectations of people that if they spend enough time grinding trade station indicators and so forth, they're going to come up with some little magic great win-loss ratio and so forth. And it just does not work that way, although I'll show you a way to get close at the end of this and the ultimate teaser for you guys. Okay, see, same thing here with corn. Overall, you've got this downtrending channel, or a nice linear regression thing going on, and then you have these freak pops up, which probably could be related to short covering squeezes, if you will. Who would have guessed that if you were looking at this type of data, we made a higher high above this high, and yet then failed, came back down through that equilibrium point, and again all the way back down to new lows. All right, so our minds, here's what happens, is that the frequency of occurrence of these things is so low, and they never play out the same way. It's not like you can go back through the textbooks and find choice examples and say, oh, I've got a collection here of 50, chart examples showing this. It just doesn't work out that way. They're random, they're chaotic, they go further than we think in one direction and further than we think in the opposite direction. And I think everybody here would agree with me that if you could just eliminate your biggest loser, all right, from your trading account each year, you would be that much wealthier. And usually our losers come from getting cute, if you will, thinking, oh, okay, I'll buy the pullback in this and not using a stop, and then they'll average down. And it just takes one time when you're in one of these little positive feedback loops of averaging that could take you a month to make back, right? Okay. I bet everybody would agree with that, and if you don't, then you just haven't been trading long enough, because it's one thing that happens. So systems thinking. Let's get back to our big model here, looking for the aberrations, the changes in the relationship. We've seen already that unusual volume or tight contraction, meaning that you have wound back down to that equilibrium point. The gaps and the big range bars can give clues about this instability in the system, where it's going to flip from one state of the negative oscillations to this other state of Katie bar the door, everybody dog pile in or dog pile out. And that's exactly what we saw today with a gap down, a big 5-minute bar. We didn't trade above the high of that 5-minute bar, and it was a steady one time framing movement all the way down until, of course, it found support and had a reaction back. All right, so look for those aberrations, be aware of them, always be on your guard with your own trading and your own self, that even if you're not in a position where you have a way to capture it, all right, and sometimes recognizing something like big gap, let me just frame out the first 15-minute bar. Let me see the initial balance. Let me see if we take that out with increase in volume or increase in range, or today the breadth was really appalling. And yesterday we had the opposite. We had a big gap and very strong breadth, but yet the highs were really made in the first 30 minutes on most instruments, and it never was able to push above that. So Even if you don't have a way to capture it, be aware, check yourself that you're not making a trade out of frustration, that you didn't get the short side, now we'll follow it down and look for the long side. You need to sit there and step back and say, what is happening here? Are we finally tipping our hand? Okay? There's this constant awareness that these big feedback loops can come up and smack us on the backside if we're not careful. So let's go down now and just look a little bit closer again at some of the things that we can recognize. Volume obviously is a very key factor, and especially when you see volume at the end of a swing or beginning of a swing, all right, that's what I've found. Anytime I see that we've had a good swing down and I see a big volume bar coming in to the upside, I'm all over that. And what I want you to notice here on this chart is how much data we have, but really how few opportunities there really were. I mean, this was pretty significant up here at the top when we started to have that sell volume come in off of that little wedge. And really, I think this is the key to trading these days, is having the patience, not making marginal trades, and it's a difficult thing to do, waiting for a particular pattern to unfold. So you can see also just how much data there is, but like how few big volume bars there really are. The market spends a lot of time in nothingness, and of course in the night session, the Globex, you're going to see this type of consolidation because there's just not the volume there. All right, so again, everything looks great after the fact, but look at the volume that comes in when you took out the high of this. Now, if I drill down and I look at a 1 minute bar, I will see the majority of the volume coming in right at that, right when that high was tested. So take a look at that for yourself. When you do see the volume come in, you can really go down and see that it's really in just a very brief period. Notice I jumped back out to a 120-minute candle volume chart on the Australian dollar. Okay, one of the you know, I just got through talking about these negative oscillations and trading ranges and so forth, and of course, you know, it's very easy when you know, the market's well behaved and you can define good channels and so forth. And I'm not here to necessarily lecture how to take advantage of this, okay? I just want to point out that the best clues are when we do penetrate these lows and you don't see the heavy volume come in, okay? We didn't see any heavy volume come in there, that instead it's you almost have like a volume divergence or a momentum divergence at the end of that swing. And here's what I'm talking about, where you see the big green bars coming in, a shift in the buying coming in. Same thing here at the bottom, a good shift in the buying. And I know this data is all squished up and so forth. So for me, my #1 tool that I use in trading, and I have no pride, it's simply watching the previous swing highs and swing lows, and that's for me evaluating if it's going to be a false test around the previous swing high or swing low, or the pockets where you get the channels. I'm looking for resistance or support, and you know, I love the traps where it pokes up above a high right here and then comes back down below that. I'm always on guard for the bull traps and the bear traps. And again, the volume that comes in after these consolidations. So that, in a nutshell, is where I focus my energy. But the problem is that it takes a lot of time. It's you know, like if you're watching market profile charts, a lot of time, a lot of monitoring, and you know, despite all the little modeling and research I've done over many years, they're just models. There's, you know, no shortcut for an easy strategy out there. Now this is on the bonds, and I wanted to bring up the bonds because I see the least amount of algorithmic activity in the bonds, which means that they are, in my opinion, very well behaved technically. And for those of you that do look at volume, I find that the bonds probably are the best market out there, the bonds and the boons, in terms of confirmation with the volume analysis. And you can see easily the increase in volume at the start of the moves to the upside and the increase in volume when we break to the downside. Now keep in mind, when I'm looking at this data here, you will always have an increase in volume if there's a significant economic number, but still, you know, the charts don't know that there was data there at that point. It still creates the patterns that it creates. And interestingly, there was all this nice volume when you were first working out the upside, but look at how on the last two rallies, there was hardly any volume up here at all. And both times, once we start to break from these highs, in fact, even here, you had this increase in volume. So I just thought that that was really worthy of pointing out. And this is very significant here, the big increase in volume. And of course, where are the bonds now? They're all already pushing all the way down here. So the volume is confirming, but you know, I know that you guys know this stuff already. It's just different to see it displayed this way. And the bonds, always keep an open mind to trading this market, or the boons if you have access to them, because they are so remarkably well behaved, and I think a little bit less prone to the noise from the algorithmic activity that you might see in some of the other markets. So obviously you get it that we hit these points where you can have this positive feedback loop. Obviously you know that some of the things that can trigger this are stops, market imbalance, sentiment too extreme on one side or another. It's probably not going to be the event itself, all right? And once we're in one of these modes, you want to be thinking trail stop, don't project. I can't tell you, like when the market was falling out of bed today, and we're getting a little bit pushing down in that 25, 24, and I have this little Skype group that's, you know, just some friends and stuff like that, and all of a sudden, out of the woodwork, you know, measured moves come down to, you know, 21.18, and 21 was the last low, and da-da-da-da-da, and all of a sudden, it's like we become myopic in our projections and stuff instead of thinking, are we starting to form divergences, or where can we react back up to on the other side? You see, nobody knows where we're going to go, right? Nobody. Everybody can see the previous swing lows, but it doesn't mean that we'll get there either. And, you know, we still could get there at some other point later on the week. I don't know, you know, but our tendency as traders and humanness often is to do these projections. So be on guard against that. And flip side of the coin, in this negative oscillating trading range environment, what is your trade management strategy? Your trade management strategy is going to be play for target, either a short target or a bigger target, but it will not pay to trail a stop. You're better exiting your longs as the market is going up, or exiting your shorts as it's going down, and you're never going to get the bottom tick. But it is more profitable to think that way as opposed to trailing a stop. See if you can test the upper and lower ranges or a previous swing high or swing low, and that is going to be the appropriate strategy for when you're in these trading ranges. Okay, it's okay to get out and get your 3 points and have it run 8 points. That happens sometimes. That's okay. The biggest thing I see people bitch about is that they got out too early or they got out too late, and there is no perfect way or method to exit a market. Just take what you got and bank it, write it down, and say, I'm up 2 points for the day, I'm up 4 points for the day. Leave it at that, and don't get caught up into, oh, I got to get back in because there's still money on the table type of mentality. All right, just for kicks, I wanted to show, now that I've showed you how impossible this short-term data is, very impossible, I just wanted to show you an idea. Okay, this is not meant to be a mechanical system by any means, but I wanted to show you the way that we can still think linearly with price. And I went down to 5-minute data because that is the most impossible data to work with when you are trying to model something. And this is very much the type of strategy that has dominated the market on the stock side, the buy the dip mentality. Okay, you know, when the RSI is below XYZ and price is above the moving average type of thing, right? Right? You guys all know what I'm talking about. I mean, how many services sell, you know, okay, this stock's back below this RSI, and when it comes back up here, buy it, and the whole thing flips back up again, fueled by this lovely environment of easy monetary policy. So this is the exact same type of principle that we're looking at 5-minute data. And I wanted to point out that anytime you start looking for a strategy that's going to be essentially a retracement or a reversion to the mean or short-term entering in the trend or even long-term entering in the trend, it is very important that you use a filter. And so the two filters I use with this type of strategy, and this is just a hypothetical example to give you ideas, is A, I'm only going to use this type of mode or methodology in the morning session. Okay, that's when you still have Europe open, you still have the majority of players. We get our highest degree of trendiness in that early morning session, and we usually have our best volume as well. So those things are really important when we're making our trades. We want the volume, we like the broad group of people you know, trading with us, and this is simply a little dot. This is my photon candle charts. This is my execution platform. Actually, I can put my little lines right where I want to buy or sell on here. Whoops. And these little dots just pop up. They're not very discriminating. You can create them with like a short-term RSI or a short-term stochastic or normalized momentum. There's a zillion ways to do this, okay? So these things will pop up on my screen. And of course, I usually keep like 2 moving averages, so I just threw one up here because it gets a little distorted with the candle volume chart. And but you just want to make sure that you've got some degree of trendiness, higher highs and higher lows, or lower highs and lower lows, however you want to visualize it, and then use that to initiate your entries. And I'm usually fairly aggressive in shorting the reactions and not necessarily waiting for it to turn, so sometimes you can be a tad too early. But this is just a little short-term scalping thing. What I do is I usually look to make 1 or 2 trades a day only across, you know, 6 or 7 different markets. So as you can see, you've got plenty of spots to go in. I just try to find maybe 1 on 2 different markets a day, and it's just a little supplemental value-added thing. As usual, you can see once you get to the end of the swing, flags or retracement patterns are probably not a good idea. So the little dots, I have to tell you the origination of this strategy too, because it's kind of funny. Most of the things that I've worked with or come up, they sort of happen by accident. So originally I was looking at applying rates of change on short-term data and using it to initiate in the direction of a breakout. So I had a threshold that it had to be a new momentum reading or however you wanted to quantify it, as well as a new low, a new 20-bar low or a new 20-bar high. So the principle was that if I got one of these in the early morning, a breakout, it would be the old adage, momentum precedes price. It serves as your trigger to an entry, and you know, you exit as you go towards Europe close in a perfect world, right? In a perfect world. And wouldn't life be so grand, right? So it actually does work well using it as that type of method, you know, thinking that these initial new momentum lows, you know, lead to follow through. But at the same time, I noticed, golly, you know, this seems to be even more interesting using it as as a counter trend type of thing, looking to enter in the direction of the trend. So that's how it came up there. And sometimes I turn them all off because it can be very noisy, but I just wanted to give you an example of if you are going to work to develop a mechanical type of strategy, first you need to be discriminating as to the time segment that you are going to use, B, the conditions that you're trading in, and sometimes you'll see the easiest little mechanical strategies. You might as well say, well, why don't you just get short and stay short for the whole day if it's going to be that degree of trend, all right? This was the flip side. This was the same day. This was actually in the crude, and I just wanted to show you how you get these little small reactions down. You know, it's a way to enter a morning trend if you've been left in the dust, which is very difficult once we get these positive feedback loops. Like we had this morning, we had one of these pop up after the first 20 minutes or so, and that was it. So that was your one graceful entry that you had. And then a lot of the times, just to show you why this is probably not a very good practical thing to try and program mechanically, this is the difficulty that we get in working with this data, is that most of the time the markets are very noisy, all right? It looks great in hindsight seeing the tests of these highs and lows, but you can't trade with this, honestly. I mean, you'll be in a loony bin, you know, drooling, you know, before they have to cart you out. So it might look good on the surface. In reality, is it practical? Absolutely not. You know, you really need to put it in the context of some other types of filters. Higher time frame, volume, degree of trend. All right? So, step back. I know I've babbled a lot about very abstract things, and hopefully the main points here about this constant flipping back and forth of states, these positive feedback loops, which may or may not be these straight line types of moves like we had today. Sometimes, as you can see in that boom data, we can go break out to the downside, then spaz way up to the upside, and then come out to the downside. And it really doesn't matter if you're looking at time series data that's 5 minutes or, oh, hold on one sec, hold on. Let me call you right back. That was my mom. She's flying in. I got to tell you a story about my mom before we go. Okay, she's flying in to Chicago. So, system thinking habits. Google this stuff, okay? Only about 5% of it is relevant to the markets, okay? Only about 5% of it. But it will make you look at the way that you are doing things. It will make you think about the big picture. All right? Very important. Quit thinking about the short-term events. They lead you to reactive behavior. Be aware of your own linear thinking in your own head and your tendency to project, okay? The hard thing is that once these pockets are hit, we can't see them unfolding. When that gold was breaking down, okay, we could see the point that it was a breakdown there when it was coming out the downside. What are you thinking? Oh, we're down $10. Oh, we're down $15. Oh, we're down $30. Hey, we're down $40. All right? You can't see that that's going to unfold, okay? So these don't be surprised by that type of stuff. And you can see the structure there, you know, the imbalance in the market, this major critical point, and so forth. Just accept the fact that there is so much gray area in this market. It is very frustrating. I know it is. I struggle with, you know, my models and my numbers and my statistics like every single day for over 35 years. You know, that's the way the market is. And you'll do best if you can just turn off the little wheels in your head. Hey, today is a light volume day. It's choppy. I'm not going to get chopped up. Maybe I'll pick off 1 or 2 little trades, whatever the case may be. Maybe I'm going to step back and wait for you know, a more dynamic type of indication. Okay, just accept the fact that there's so much that we don't know, we can't control. Almost every professional trader out there has had a losing year or losing months or losing weeks or, so forth and so forth. So we're very limited as to what we control. The main thing that you can control that's going to make all the difference in your ability to survive in the markets is don't take a big loss. Don't average down. Don't pyramid when you are in one of these positive feedback loops, because almost everybody, including myself, at one time has done that. Oh, well, I'll just add, and then I'll be able to get out for even on the first reaction, right? So simple, right? Just a simple little thing. And the more rigid you can be in your own behavior, the better off you'll be. So lastly, your own system design, all right? When you think about your trading system, I want you to think about your trading system as a collection of processes. You have a system for how you go about your analysis. You have a system for how you monitor your trades. You have a system for how you are going to set up your trigger or your bracket for your entry, all right? And lastly, you have a system for how you go about trade management. I believe I did a webinar a couple years ago on habits, all right? And systems for habits and how to change those. So there's a ton of wealth of information that you can research on your own on the internet. And at the very least, I know I didn't provide any really slick, strategy here for entries or new gimmicks or tricks, but I really wanted to, especially in the environment that we're in now, just increase everybody's awareness for the erraticness, the randomness, how we can't predict or control, but we can watch for those volume bars. We can watch for the structures where you've got the increase in range or the gaps or these imbalances of extreme sentiment readings, or if you look at commitment of traders reports, which honestly I do not, because it's gotten me into trouble just as much as it has helped. But you get the idea, and constantly be stepping back and peeling away the layers of the onion so that you can see these massive structures. Go back and those slides I did in the beginning, I know this webinar is going to be taped and you can fast forward it and you'll see going from the 5-minute to a bigger 5-minute to an even bigger 5-minute to like so forth and so forth, so you can really see how there's this nestling of systems within each other. And then again, bring that back to your own processes for going in the day. And I hope that somehow this webinar was insightful. Today was certainly a day that we could look and see how it unfolded and put some of these things into practical application. So one last little thing here, okay. This is, I just mentioned that was my mom who called. She's coming out to Chicago. And this is just an example of tenacity and grit, okay. Grit is something that you've got to have, perseverance and grit to be a trader. Okay, this lady, she's turning 80, and she had decided all her life that she wanted to go see Africa. She'd never been over there. Her husband passed last year. So she goes over there, safari with her friend, 5 weeks. She's going to be over there for 5 weeks. Now she's had her knees replaced, her hips replaced, but by George, she's got her safari pants on, her hiking boots. And what does she do? The first 3 days that she's over there, she trips on the wooden platform getting into the tent. I don't know what safari thing she's on, whether she's in some big tent or something like that. But I get this text sent to me, and she broke her leg, and she broke it so badly, it was down by the ankle, that she had to have 6 screws put in it and a plate. Okay, now you're in like middle of nowhere Africa. Okay, so she's got 6 screws and a plate and this big incision and this big boot cast. And I'm like, oh my God, she's going to be so disappointed. She's got a, her trip's been ruined, right? So then I get a text from her, and she's like, can you contact my doctor in San Francisco and find out what that non-opiate or non-narcotic painkiller was that he gave me when I had my knee replaced and my hip replaced, because she won't take narcotics or opiates or something like that. And I'm like, oh, great, just go under major surgery and you could take a few Tylenol, right? So I called and put her in touch with him. Well, sure as shit, the next day she's having some driver take her like 5 hours north to join the rest of the group, and she's got this like 5-inch incision and just like this massive, I don't even know what it is, grossness on her leg. And she proceeds to hike all around Florida, I don't know how she hiked, she had crutches or something. She couldn't do everything, but she's sending me pictures of her standing in front of Victoria Falls, and I can tell you, I'm sure she felt pain and so forth like that. And she's the one that texts me, and she just says like grit, okay? So she made it back to the States, and now she's coming out here, and I think the whole thing ended up getting infected, and I won't discuss to you anymore. But I wanted to show you this is an 80-year-old lady, and that's perseverance and buckling it up and tell you sometimes that's what it takes in these market conditions, is this toughness and this tenacity, because it is not easy. It is a challenge being a trader. It's not always easy and gravy train, and that's why I feel so strongly about having this wonderful community that Mike has provided for everybody online, and the networks that we have with the webinars or you know, group sharing and so forth. I mean, to me, that's the one thing that's kept me in this business, is having people like you, or being able to help or share my thoughts, or hearing other people's stories and so forth. And so even though I retired 2 years ago from money management and so forth, this is what I live for, is being able somehow to you know, provide some type of value for you guys. And again, if any of you have stories and want to email me, my email is lbrgroup@att.net. And now we're going to open up for questions.
Okay, thank you. That's a great story about your mother. That's just awesome. Let's see. If you have any questions, please feel free to type them into the questions box. Let's see.
Oh, you want the author and name of the book that I mentioned, okay? That book, it's great. It's an easy little read, and the only way I can read this stuff is with a yellow highlighter. But it really got me thinking. And the book title is Thinking in Systems by Donella Meadows. And I see somebody else already posted that answer there. You guys are so smart, or else you're in a daze after today's trading.
Okay, there's a question. Can you please show on a chart what the 3-bar overlapping equilibrium you spoke about looks like, and which conclusions to draw?
I'll tell you what. I'm on a laptop with this. If you email me, lbrgroup@att.net, but I can give you, let's see, I can give you a couple little examples that you can look at for yourself. First of all, right now in the gold market, we're starting to form 3 bars overlap. Now that just means that we're starting to hit an equilibrium level. A lot of the breakdowns that we had coming in, I think the most dramatic or striking one would be if you looked at the Japanese yen, okay? The candlestick charts of the Japanese yen, and this would be on October 4th, all right? So you can see that the 3rd and the September 30th, right at the end of the month, you had almost what looks like 2 inside range bars. So that's an extreme 3-bar triangle or coil. And even at the very top, you had 3 bars of price overlap. So it was one 3-bar grouping followed by another 3-bar grouping. And that's on the Japanese yen. And then if you go and you look at a 120-minute chart of that yen, and the price that we were trading at the time was around 99. Okay, the 99 handle was a bit of a volume node there, if you will. So you'll see a triangle on that 120-minute data, and then that led to a pretty significant drop. We dropped 2 handles, which is a good move for that in 2 days, more than 2 handles. So I hope that serves as a good example.
Okay, let's see. Do you enter into a position all at once, or do you scale in and scale out?
I pretty much enter all at once. I like to put it all on at once, and then I'll usually take it all off at once, or I might take half off and try and get better on the second half.
Okay. Can you explain the dots on your chart again?
Yes, those little dots. In fact, I'll go back up here and put them up. There we go. This is just simply a little short-term momentum function, and there's ways that you can normalize this or play all sorts of little games with it. If you look at 2 or 3 period rates of change or RSIs on those, or you know, that type of thing. This actually is with the Photon platform, but it's just a fun little crutch. I'm happy to send more examples if you want to email me.
Okay. Are you planning to attend the Trader Expo in Vegas?
No, I am not going to be there.
Okay. Do you also have a system for process review so that you spot things that don't work anymore or improve?
I'll tell you, that's probably the best question so far, you know, and that's a good way to phrase it. A system for review, or a system for self-critique, something along those lines. And actually, I don't right now, because I hit time constraints, and I used to do it very rigorously early on, and I don't know if it's just that I know all the times that I'm going to be in trouble now. Perhaps I'd be a better trader if I still did it. I used to log all my trades, all right, so that's very important, writing them down by hand. It's harder for us to do nowadays because with the electronic trading, I think that my trading activity overall is much higher than it was when I used to have to call down to the floor and place my orders with the pit. But then I would be very rigorous in using my Taylor approach. Is it a buy day or a sell day or a sell short day? And you know, the 2-period rate of change, and I've done lectures on that in the past, okay? Or with the S&Ps, you know, I probably would make no more than 2 or 3 trades a day. So it wasn't so much to write down. And then, you know, what I found over time is if I'm either not performing as I feel I should, it's either distractions or lack of sleep or lack of preparation, and I pretty much know by now if I'm going to be in one of those vulnerable states. So in which case I automatically cut my leverage way back. I'll still trade, but I just do it on much lower leverage. But that is a really important, good question, and that's the right way to phrase it. Having a system for review for yourself.
Okay, let's see, do you pyramid your position size when you realize the market is in a positive feedback loop like those trend followers do?
You know, it's funny. I don't. I've done the algorithms for adding at those points if I were doing a mechanical system, but I try to get on my best size as early as possible instead of adding. And that's because I don't know if that positive feedback state is going to last or if we're going to have a snap back sharp reaction. I mean, there's a lot, that would be the same as having a false breakout. That could easily happen. We can say, well, the odds favor, a breakout and extension here, but there's no guarantees. You can also snap back too. So I try just to recognize it early on, and sometimes, although we have not had that many opportunities actually, but in the good old days when the moves took longer to unfold, I'd try to get a core position on very early in the day and then add or do a supplemental trade like on a 5 or 15-minute type of continuation pattern. But I have to say, in all honesty, much of the trading in the last few years has been, 80% of the move is done by the first hour, so it doesn't lend itself to that as much. Today was actually an exception.
Okay. Do you use market profile when you trade?
I do not, but I am aware of it, and I do have it. In fact, I have a really lovely software program called Window Trader that Terry Lieberman developed many years ago, and he partnered with Jim Dalton to provide some educational courses. And right now, the Window Trader is being integrated into the Photon platform so that you won't have to pay data fees for it. So I've actually had that at my disposal for the last 2 months, and it's a wonderful tool for looking at levels and marking off levels ahead of time. That's about all that I use it for, though. There's only so much that you can process. That's what it comes down to. Everybody has to pick their poison and stick with that, and I've just been using the bar charts and a little oscillator or something for so long that seems to work for me.
Okay. Let's see. Do you have a solution or tip for someone who cannot follow their trading rule that he or she has set?
Yeah, well, I think that you are not alone. I think that probably pertains to the majority of people. There's two things to keep in mind. You can have rules, but rules at certain time are made to be broken. Now, if your rules are things like a money management rule, that's something that you really want to honor. You have to say you got to honor yourself to respect a money management rule. If you have a rule that's something like don't go in and out of a market more than 3 times in a 10-minute period, which might be considered to be over trading, okay? Or don't average a loser, these types of rules. That's a trickier thing, because what happens is the more that you do that or let yourself get away with that, the more it becomes a habit that's really hard to break, really, really hard to break. And you have to go through the day, like 20 days not doing that in order to start to break that habit. And about the best thing that you can do is, A, just remove yourself from the situation. Make yourself watch the market all day without making a trade. Or B, have somebody monitor your account so that you're accountable to somebody. Sometimes I find that if people know that they have to share their statements with a buddy or somebody else is seeing their action, they'll be less likely to do that action. If you find that it's a habit or something that you can't get away from doing, then you have to acknowledge to yourself that you're just not going to be successful in this business. That's what it's going to come down to. So I'm sure different things work differently for different people, but you have to find some way to stop doing it as soon as possible, even if that's sitting on your hands and not making one trade. Or perhaps go to simulator mode so you can have the feeling of following the action but not betting real money. And I always would suggest start off smallest size, 1 contract, 1 trade, that's it. You get 1 trade a day, and then the next day just try to make 1 winning trade. So it's really important too, when you've had a bad drawdown or a bad experience, don't think about the money, think about just turning the tide, turning that momentum. Start from scratch again, wipe the slate clean. Your job is to go in and make one winning trade, even if it's 3 ticks, so that you end up that day green. All right, don't think about the money, don't think about anything else, and see if you can have 3 winning days in a row, even if you make $200, even if you just lost $5,000. Try to shift that momentum so that you can feel positive about your actions, positive that you're in control again, and then things will come naturally from there. But that's about all I could say.
Okay, were you going to illustrate a money management technique? I believe that you started to, but then you went in a different direction.
The biggest things to remember, because people always have a quandary as to when to trail a stop or when to play for target. And the biggest thing that I want to say is that when you are in a trading range, all right, it's best not to trail stops, okay? It's as your reason to get out. It's, of course, it's fine to have a stop and tighten the stop. That's always one consideration that should be a given, all right? But and I usually start with stops very wide, and then as the price moves on in my favor, I'll pull them up to break even or whatever. But you don't want to use that strategy by which to take profits. You're better off selling, you know, when the ducks are quacking, feed them was the old expression, you know, putting out an offer, letting the market take you out or come to your price, or then if it falls short of your price, what I always do is I'll stick some price out there, and then if it starts to fall short, I'll just hit my flatten button and just it'll get me out of everything and cancel everything. So I love that flatten button. But don't use the stop to take your profits where it's going to have to come back 6 ticks or 7 ticks and then you get stopped out. Don't do that in a trading range. On the other hand, when you're in one of these positive feedback loops like today, just keep on trailing a stop, and that's the environment where it's okay. Maybe it gets down to 22 and you've got your stop pulled down to 28. That's fine. That's fine if it comes and stops you out at that point. You know, some give back would be expected. Anytime you trail a stop, you're going to have give back when you exit. In other words, your open profits, you might have open profits of $1,000, but by the time you lock it in, it's $800, okay? Contrast that to when you're in a trade, in a trading range, and you have open profits of, say, $600, you bank it, and you're taking that $600. You're not waiting for it to drop back down to $400 and then getting out. You've got to understand that difference, all right? Think about your open profits and what percentage of those open profits you bank. And you want to be able in a trading range to bank as much as your open profits as possible without give back, and it's okay if you bank it at $600 and it goes to $1,000, that's okay. You don't want the give back though.
Okay, let's see. You mentioned that most of the market move is done in the first hour. What have you found out about the slippage on market entry before the open on major indices?
I don't have any.
Okay.
Simple. I mean, I never look at the New York opening. My day sort of starts at 7 a.m. Central Time. I usually at my desk at 6:30, 7 a.m. Central Time, because that's when New York, you know, the New York institutional boys sit down at their desk, 8 a.m. Eastern Time. That's when, the bonds used to open shortly thereafter. That's always sort of delineates the start of my trading day. So the S&Ps, I'm looking at 7 a.m. as being the start of my trading day. And with that said, I'll usually look at the DAX. I'll see, are there any significant patterns with the DAX? This morning coming in with the DAX or the Euro stocks, either one, they both had like hourly sell divergences. They were textbook. They were perfect. You know, the DAX had rallied and taken out yesterday's high or the day before, and there's this beautiful hourly sell divergence. So I'm like, okay, that's my dominant chart formation. And I'll actually look, not always, but sometimes to base trades in the S&Ps when there's a good chart formation in the DAX, and then it carries over into our session.
Okay. Do you have some automated system at all, or are you all discretionary trading?
I'm 100% discretionary. With that said, I've developed a lot of mechanical systems we did some during periods when I had my hedge fund. I was a CTA from 1991 until just 2 years ago when I stepped down. But probably the only mechanical system that I really felt strongly about, once upon a time we used to do something called the golf trade, which I invented, which was initiating on the close in the S&Ps and playing for a fixed target. So I did that mechanically until the Asian currency crisis in, I think, the 90s or something put an end to that game. The gaps became too great. And then the other system that I've learned a lot from in my growth as a trader was trading a volatility breakout system. And I would recommend that to everybody, even if you paper trade it, because A, you'll find out how much work it is, okay? Even if we had the thing automated where it was with the trade station at one point with my fund, but we still had to pay a guy to be up all night to make sure that the fills were correctly filled when the sugar market opened or stuff like that. It was really kind of a pain in the neck, but it still teaches you a lot about the laws of numbers, that 80% of your profits are going to come from 10% of your trades, and the power of that range expansion when you do get it, and just how much noise you encounter along the way and whipsaws in trying to capture that. So it was a really powerful learning tool. It's just it didn't quite make enough money for me, and I'm not a trend follower, nor do I believe in the trend following long-term systems. So it's really hard for me to have come up with a mechanical strategy that's durable and robust where you could do size and not have much slippage. Everybody's sort of playing that game that's these big, Monroe Trout, Toby Craybill, X type of ways of trading.
Okay, that's going to be our last question due to time, so we're going to move on to the quiz for the books. Okay.
Oh yeah, we used to do breakout of the first hour range and the S&Ps, alpha NR7s, and all kinds of fun stuff, just little patterns, but I think those days are gone.
Okay, Linda, are you ready to move on to the quiz for the books?
Let's go.
Okay, you asked a question, and I will look for the answer.
Am I asking the question, or are you asking the question?
You asked the question, and I'll look for the answer.
Okay, let me go back to my question.
The book being given away is Thinking in Systems by Donnell Meadows.
There you go. Okay. What is the goal of negative feedback oscillations?
Bingo, we have a winner, Stacy Hockadeck. That was the first question, or the first answer.
Right, the market's trying to find an equilibrium level, testing back and forth so it can come to that central value. All right, what are some of the things that can cause system instability?
Looks like Wilhelm Thomas has it with feedback loop.
That's right, and those all arise from market imbalances and gaps and time delays and this amplification of information, everybody jumping on one side. All right. So what type of behavior, now this is a little bit redundant, sorry. Okay, what type of behavior can positive feedback loops lead to? There's several different things you can mention on that one. I hear a cat. Okay, so if there's something, if somebody mentions something along the lines of exponential behavior, which is like parabolic, okay, or randomness, or chaotic behavior. In other words, something that's not predictable. So when we're in our negative feedback mode, we're all happy buying low and selling high and trading around a central value area, and life is easy and good. And when we hit these pockets in the market, everything is unpredictable, exponential, accelerates further than we think it can, sometimes very erratic or random, fake out to one side, come out the other side. So the analogy is obviously when you hold a microphone next to a speaker and you start getting that feedback, and it can cause noises, you know, amplification and lead to some obnoxious noises. All right, so nobody came close, huh? I'm a lousy teacher.
There was, let's see, the way this thing updates sometimes, it makes it hard to keep track. The first answer was noise.
Noise is actually the opposite of positive feedback. So noise happens a lot of times in these negative oscillating things, and noise is chop. So you want to think of noise as chop, and that's something that will happen in the trading ranges. And you know, noise actually lends itself to making little reversion to the mean trades, you know, little false breakouts in either direction. So okay, what happens in the opposite situation these days is the market becomes very efficient when it's in a positive feedback mode. So a market that's very efficient doesn't take the time to digest back and forth. It's this straight line, linear movement. You know, whoever hits the bids first come, first serve. And that's why it's very frustrating for newer traders to trade, because when you're used to working with the market, to buying a little reaction or shorting a little rally up, you don't always get that in these very efficient straight line moves. Like if you can think of the way that gold was peeling out the downside a couple days ago, and it's so efficient that it ends up being this parabolic straight line, very linear type of movement, if you will. So it's important to understand that difference, because it's the one area that a lot of people can get into trouble early on. So if you're newer, just study those rare occasions and be aware that they can happen.
Okay, so would market imbalance be closer?
Well, you're looking for the type of behavior. So you're looking for the type of price behavior that can happen in a positive feedback move, and you can get something that goes much further than we think. Okay, parabolic is a good word. Exponential, increasing in its momentum, if you will. So acceleration.
Okay. I think I got the winner. Expansion beyond a logical range.
There you go. Good enough.
Okay, Carl Rosenberger. And if I call your name, please stay at the end so I can get your contact information for Big Mike to contact you and send you the book. Okay, let me scroll down here. Okay, it is fine. Okay, ready for the next question?
Yeah. All right. Now you go. I know people are right on top of this one. Everybody's going to hit the buzzer on this one. So what are some of the variables that precede these positive feedback loops? What are some of the types of things we've got to be aware of in the big structure of things? It's kind of funny because it's such an abstract subject material. Here we are asking questions that kind of demand a linear type of answer, and it's, trying to go about that a different way. All right. What point are we going to hit the free fall in those markets?
Okay.
Everybody wants to dogpile in or dogpile out.
Kind of like them answering the questions.
Yeah.
Let's see. Sentiment imbalance?
Absolutely. Yeah, you have several things. You've got an extreme sentiment imbalance because that means that everybody's on one side of the market, so the market becomes overweighted. And this is important just to recognize. I mean, it's not that everybody's bullish or everybody's bearish and that's going to cause a reversal, but a lot of times when you hit these pockets, the logical explanation given by the news is that there was some event. See? It might just be the straw that breaks the camel's back, but the underlying structure was there already. And when you read about systems dynamics or system thinking, they refer to something as the iceberg in the structure. And we always just see the tips of the iceberg, but there's all this structure underneath that is building up to these things. So these types of dynamics where you have a unsustainable market composition, okay? If all the funds have already bought gold and there's nobody left to buy, that's an unsustainable market composition. So the sentiment is one way of measuring that. The COT reports for some markets. Some people like to look at put-call ratios. When they hit an extreme, it leads to an unsustainable type of condition. Or stops can be hit, breach of major support or resistance level, then triggers and stops, then pulls in trend followers, and it becomes this self-fulfilling waterfall, if you will.
Okay.
And then lastly, okay, so what type of money management do you want to use when there's a positive feedback loop going on underway?
Scott Walls.
Trail a stop, trail a stop, trail a stop, because it only takes 1 out of every 10 trades to lead to a huge big win and make your month. Sometimes it only takes 1 day a month to make your profits. It's that outlier, and so the only way you stand a chance of capturing that outlier is to trail a stop, even if it's a false breakout and you get stopped out. And it's tricky learning the right and wrong of trailing a stop. Usually you want it you want to get a little bit of room under your belt and pull the stop down. You don't want to trail it too tight that you get jiggled out on a little reaction. Some people like to simply just use a 20-period moving average on a, a 5 or 15-minute chart. That's fine, or a 15-minute chart, or a true range function such as the upper Keltner channel on a 5-minute chart. If it's in a downtrend or if it's an uptrend, use the lower Keltner. Those are just little day trading tricks. And of course, once in a blue moon, if you're a bigger time frame trader, then you can sit there and trail your stops on hourly charts. Always look at the bigger structures. It was interesting coming into today as well. A big technical structure that I've not heard anybody talk about, but you can see it on the charts. Is you had both daily momentum divergences and weekly momentum sell divergences on the NASDAQ index. That's been the relative strength leader. So I always like to look for the momentum readings on the relative strength leaders when the market's in an uptrend, and the relative strength laggards when the market's in a downtrend. So that's something cool that you guys can look at. Just look at the weekly NASDAQ chart, and you'll see perhaps there's a higher time frame at work here that helped tip that wobbly top over.
Okay, the winner of the fourth question was Lewis Jacobson. Everyone, please check your chat box. The winners, I've sent you a question asking for your email and FIO username.
Didn't we do 5 questions?
Yes.
Yes, okay.
Yes, I have 5 winners. I just forgot to mention the fourth winner. But I'm still waiting on Lewis and Wilhelm.
Aha. Hey, I got to say one thing. I always try and I hope that this was still of value, because I always try to pick a topic that is something that I haven't done anything on before. I mean, you guys don't want to hear the same old on a 310 oscillator or a Keltner channel or something like that. And I know that Mike's really superlative about archiving his webinars, and you guys can go read all the little gobbledygook, gimmicky tricks and fun stuff and research, that I've lectured on in the past. But this was a little bit of a stretch for me, trying to take some of these concepts, system thinking. I was really inspired by this book. In fact, it's not a very expensive book. I'd recommend it, reading it, just because even not about the markets, but about the world around us, the environment and our ecosystems and social structures and organizations, and so many different layers, to all these wheels that are turning around us. It really is a good thinking book, that you can browse or just read one chapter at a time. And I was trying to think, like, well, now how is this applicable to the markets? Because I just was getting a little bit tired of so much being put out there on the quantitative side. Like, it's not so easy, it's not so easy to come up with a little quantitative system or mechanical system. And I'm like, it sounds good in theory, and a lot of people, sell services or consulting services or their books on this stuff, but why are they selling this stuff and not trading it, Why aren't they running their big giant old hedge fund, raking in the money? Because, it's not an easy game, and it's not an easy thing. And I really feel that the people that have been on Mike's chat and forum and blog and some of the other lectures, especially, with the market profile stuff, you guys really get it overall, that, it's just a lot of patience and monitoring the market and finding those spots, where there's better risk reward. And so, this was a stretch for me, and I hope that you guys got something out of it too. I was trying to collect my thoughts at the end of today, because I'm like, oh, this figures. This is just going to be like a crazy day, all day long, of course. And then I still have to be coherent at the end of it. So, any follow-up questions? lbrgroup@att.net. I am happy to answer them. And no, I do not have anything that I sell. No services, no nothing. So there's no chat room, there's no nothing.
Okay. Based on the comments, it looks like everyone really enjoyed the webinar today. Lots of good comments on the content, and it seemed to be something that a lot of people needed to hear. There is one question on your slides. Can you email me that slides? There's people asking for it, so what I'll do is I'll put it up on the thread on futures.io so people can download it.
I will do that. And everybody get a good night's sleep tonight, and hopefully the volatility is here to stay.
All right. Thank you very much, and it was a pleasure.
All right. Night, gang.